Ladies and gentlemen, welcome to WealthDom. With me, your host, Norbert BM. This is the weekend edition. Today we're going to go over, as usual, the portfolio changes and, of course, the happenings in the last week. So let's get started with the market vitals, and after that, we're going to go into the portfolio changes. Now, looking on the weekly performance of the market, the S&P, the Nasdaq, and the Dow Jones all closed in the positive due to a really positive unemployment rate. Speaking of unemployment rate, let's jump into the market vitals for the last week. We had on big economic events. On Monday, we had from China, the PMI manufacturing report came in better than expected. Then we have from Italy, the inflation rate report, which came in also better than expected. Then from Germany, the inflation rate year to year, that is, it also came in better than expected with 0.1%. Overall, the entire European Union had a relative disinflation or reduction in the inflation, in the pace of the inflation. It doesn't mean that inflation is going backwards, but it just means that the inflation, at the rate at which inflation is growing, is actually reducing. So, not less inflation, but less growing inflation. Fed Chair Powell had on Monday its speech, and a bunch of chair members also had their speeches. Then on Tuesday, we had from Japan, the manufacturing report came in as expected. And from the European Union, we had the inflation rate, as said on Monday. We already had two major countries reporting their inflation. So on Tuesday, the inflation rate came in better than expected, of course. Then we have from US, the ISM and PMI manufacturing report and the JOLTS report both came in pretty good. The market did start to tremble a bit on these reports. Then on Wednesday, we then didn't have any kind of major report except from the consumer confidence from Japan. It still kept struggling, the market. Also on Tuesday, we have from balance of trade and ISM PMI from the United States and from Australia, the balance of trade. And then on Friday, after the non-farm payrolls and the unemployment rate came out better than expected, it just, boom, massively exploded. The whole market got back basically all of its losses in 1 week, and it did end on a massive green. And we're going to talk about this later on at the end of the video, where we're going to evaluate the risks looking forward in the market. So definitely stick around to the end of the video. Now, looking on the week ahead, it's pretty interesting. Now, Monday, we don't have anything, so expect the markets to be pretty much the same as it was. Also, China is going to come back from its week-long trading pause. And an MBM from Australia, MBA Business Confidence will come out on Tuesday. Then also, we have from Canada, the balance of trade. Then on Wednesday, we have from Australia, Consumer Confidence Index. From Germany, we have the balance of trade. And from the US, we have the FOMC minutes. This could influence the markets, of course, if they change something in their minutes. On Tuesday, then we have from the US, this is basically the entire Tuesday is only US with core inflation rate year to year. So the core inflation rate month to month and year to year, and inflation rate, which is not core, but the all-around inflation rate with month-to-month and year-to-year. And then on Friday, we have from UK, the GDP, month-to-month, and from the US, we have the PPI, month-to-month, and unemployment rate from Canada. And then we're going to close up the week with the Michigan Consumer Sentiment Roll. Okay, so it's going to be a really interesting week, not that big of a deal. Maybe inflation comes in worse than expected, and then we're going to have a major problem. But until, let's say, Tuesday, we're safe. So whatever the market closed up on Monday, I believe is going to throttle around in the upcoming weeks. And we are getting extremely near to the next earnings reports. So with this, we're going to wrap up the report for the markets, and we're going to move ahead to performance and changes in our portfolio. Our portfolio is up 0.85%, and we are on a combined current dividend yield of exactly 3% for the entire portfolio, which is in the range where I would love to have it. Everything that is above 3, so this is the maximum. I don't want it to have it above 3, meaning that I'm probably above 3, meaning that I'm probably overweight high yielding stocks, or I'm just overweight cash, because I'm getting 3.5% on our cash. Let's also talk about our cash at 10.29% of the portfolio, which is okay. I don't want to have it under 10, especially in this kind of environment, and I don't want to have it above 30. So somewhere in that range between 10 and 30, I'm feeling comfortable with the cash pile. And we also are at 29 stocks in our portfolio, as I said, yielding roughly 3%, including cash. So including cash is yielding 3%, and there are only 29 stock positions, which is around the 30-ish, 30, maximum of 35 where I want it to be. Okay, we received some dividends in the last week. We received from Pepsi a $1.36 per share dividend. Then from the S&P index, we received a $1.52 dividend. From Nike, we received a 0.37 dividend dollar per share. Then from Nvidia, we received a 0.01 cent per share dividend. And of course, we got off our 3.5% on our cash flow, which for the month of September was 0.29%. That's actually averaging out those interest rates that we're getting monthly on our free cash. Now, this is cash that I can invest. So it's not necessarily some kind of a fixed amount. So I have to have it for a year or a month or multiple months. For example, I can constantly invest that cash. That is why I love this free cash position for now. This is going to decline as soon as the ECB, because I'm influenced by the ECB. ECB is cutting rates, that this dividend yield, or actually interest rate, will decline. Okay, now let's talk about what we bought, what we sold. Of course, we did a dollar cost average into our S&P index fund, a ETF that is, a 0.60, a increase of 0.36% to that position, but it's only 0.91% of our total portfolio. We're going to come back to this a bit later on. So let's talk about what we bought. We bought the following things. We opened up actually new positions. We just opened up a pretty big position, a over 1%. Normally I want to open up a 1% position of the portfolio. So we opened right out of the gates a 3.2 position into JP Morgan Chase. Let's take a look at JP Morgan Chase. I actually created a couple of videos about a couple of these stocks that I'm going to talk about. They're not released yet. They are going to come out because I had a little break. Whatever, they are going to come out soon. Definitely check out those videos, especially about JP Morgan. So we added to JP Morgan on a technical, it turned into a buy signal, MACD buy signal, and then it stopped. If it's going to go further down, which let's just say I'm not sure that it's going to do that, but if JP Morgan is going to fall for a run, then I'm going to add to that position. Also, those of you who are on Substack already got this trade alert when I actually opened this position. So JP Morgan is on this big green candle is actually from Friday, I believe. Everything else, it was pretty much down exactly where I wanted it. So we opened a position into JP Morgan. If you want to hear more about JP Morgan, then check out that video that I will release in a couple of days. Next up, we opened up a position into a stock that I so much love and so wanted to add to it, in Ferrari. Ticker symbol RACE. By the way, ticker symbol JPM on JP Morgan if you want to search for it. For Ferrari is ticker symbol RACE. Now, at the moment that we opened it up, we opened between the 50 and the 100-day moving average. It was excellent. If this is going to continue downwards, and I'm going to add to this position, Ferrari is one of those companies that you just sit there and admire. Why? Well, let's just talk about a little bit about Ferrari. If you want to own a Ferrari, you have two possibilities. You buy an old Ferrari, or you buy an old Ferrari, because you cannot buy a new Ferrari except you're invited to buy a new Ferrari. In order to be invited to buy a new Ferrari, you have to have an old Ferrari. So you kind of see where the moat of this company is, and especially because it is an exceptionally good company. So we bought Ferrari right between the 50 and the 100-day moving average. We're expecting to add to it if they continue to slope, which will be very much obliged, because we did do a couple of changes in our portfolio, and Ferrari is a especially good replacement for that change. We're going to come to that change just in a couple of minutes. Then we added positions to, let's say we added to Novo Nordisk on the 30th of September. So right on Monday, we added to Novo Nordisk, increasing Novo Nordisk to 3.34% of our portfolio. Novo Nordisk hit a pretty much technical RSI up beneath 30. We concluded that that would be a perfect time to buy some more Novo Nordisk. We love that stock. We love what it does, especially in the pharmaceutical business, in an innovative field. They are just the best. They, and especially Eli Lilly, I would prefer over Novo Nordisk, but we do not see a good opportunity right now to add to the stock. It has a massive PE. I just say it's trading above our preferred PE ratio. We also bought some Diamondback Energy, also on Monday. Now on Monday, it was just down. But let's finish up with, so it was down. We added to the position, and we reduced the position. We're going to talk about this just in a couple of seconds. So we added to the position. It was on a perfect technical level where I missed the first technical level, which was right here. It was at the middle of September, somewhere there, right after those September lows. I missed that opportunity. I was feeling real bad, so I add back. You should never add on feelings, but due to the recent events, sad events in the Middle East between Iran and Israel, sadly, we felt that we can add to this momentum in the energy markets. And we also, let's just talk about this right after we talk about, actually we can talk about this right now. We are going to go now to sales. So we reduce positions in the same one due to the fact in FANG, because we reduce once here at resistance, and then after the breakout did 2 reductions and we stopped for now. On Friday it went up the most out of the entire week. Diamondback Energy, we could have reduced more from that position. We are now at an interesting inflection point here, so let's just see where this is going to take us. Currently FANG is, change here to the portfolio, let's see, Diamondback Energy, there we have it. Currently it's up and away. It's looking to move outside it's already over the 60 RSI, so if it's going to move over the 70, we're going to consider reducing in our position once more. But this also means a pretty rough days for both of those countries. So let's go back to our trades. We also reduced position in Cameco. Didn't hear about Cameco. Cameco is one of those companies that produce uranium. Why did this stock explode as it did? This is where we reduce our very first time, a major reduction in the position, I must say, because we reduced Cameco to 0.65% of our portfolio. And what did Cameco do after that? It kept on ripping. So we reduced it somewhere here at the 70 RSI. It's at 79. So we missed a lot of. Basically, let's just go here. It was at 39 and we missed almost 3 points. Multiply that with however many shares you have and you can calculate your losses. Not losses. Let's be serious. Missed gains. Okay, and of course, Cameco is that company that we want to add back to it as soon as the possibility occurs. Okay, let's move on now to our closed positions. We closed only one position, and that is LVMH&F, Louis Vuitton, Omid Harness, Hennessy, and Louis Vuitton, of course. So what had happened here? Pretty simple. You see this RSI, especially if you're only listening to the podcast, definitely check out the YouTube videos. On almost hitting above 70 RSI was where China stimulated. If China stimulates, everything that is luxury will grow. This is why LVMH grew from its bottom right here, and we stepped out of the position. Why did we do this? Well, pretty simple, because it was in overbought conditions. Could have gone further, but the moment of the reduction was when China also went into their blackout, but they basically went into their 1 week holiday, and nobody was buying this anymore. So we actually sold out of our positions. What it was a really big position, but we made the decision to leave it for now. Are we going to come back to this? Really hard to argue due to the fact that France wants to increase their tariffs on China, or they already did. The ECB did it, and not the ECB, the European Union already increased the tariffs on China. This is one condition. Germany had their veto. They said, no, we don't want it, but that was basically the only country that did have their veto. Is not going to matter that much. Now, this is one problem for China. For France, most of their sales come from China, and they just started a trade war with them. Not a good idea for LVMH. This was one. And second, they want to increase their taxes on big companies. For what reason, you know my opinion on taxing the rich. It just leads to taxing the poor, actually, end of the day, because whatever minuses they're going to have from taxes, they're going to give them back to the poor due to price increases. Okay, so now let's move on to market evaluations, and let's talk about market risk. So our current stand in the market is that in the last week, we triggered a sell signal. Now on Friday, we kind of negated the sell signal, and we got back due to that very good unemployment rate report. Now what I'm going to do here is a little risk analysis for the market. So this is our riskometer, and we are currently at 75% risk, meaning a high risk in the market. So how did I come to this conclusion? Well, I factored in the following conditions. The RSI, this is the bottom diagram down here, is at 63. Anything that is above 70 is very highly risky, very risky. So we are at high risk, not very high risk, only high risk. Then our MACD, as I said, was triggered as a sell signal. So normally the market would like to come down and restabilize, relieve some pressure. It did not happen due to that good unemployment report. So it came back again, but it was triggered. The sell signal was triggered. Now, in order to be confirmed, we need to re-trigger it again. So there always can be a trigger, and then we need a confirmation. So one retest, then if it falls once more, then we're mostly sure that the sell signal has been triggered. So we're going to rank this as high. The S&P is at its near all-time highs. Take a look back to our diagram. There we go. It's at its near of all-time highs. Maybe on Monday we're going to have an all-time high again. Again, the market is highly risky, not very high. The presidential elections is only 1 month away. People don't know who or what kind of policies will there be after the elections, so it's still high risk in the market, and we are actually in a highly risky season, highly weak season of the markets. We are in October, where most of the bottoms and most of the recessions actually happen. So I would also interpret this as high risk, not very high risk. So we are high, 5 times high, 5 high, and we are going to say that in our conclusion, you should be taking this seriously and consider reducing risk. What we do here, we reduce risk in our portfolio when we see such high problems in the market. Okay, that's it for today's analysis and for our portfolio review, ladies and gentlemen. Thank you so much for watching. If you like this video, give it a thumbs up. Also, if you have any kind of questions or suggestions, put them in the comment section below. What is your risk tolerance? What do you think the market is going to go from here? My name is Norbert BM, wishing you a lovely day. Take care. Catch you next time. Bye-bye.